Imagine building a company entirely around the concept of stability.
Yeah.
Like your core product is literally called a stablecoin.
Right.
But then Wall Street suddenly decides your stock should just plunge nearly 68% from its peak. It's trading around $60.95 right now, and the sentiment is just wild.
It really is. We are looking at a fundamental stress test today. The situation with Circle right now is honestly a masterclass in how quickly macroeconomic weather and, coordinated industry attacks can just destroy what looks like an impenetrable moat.
Yeah, welcome to Market Pulse Daily. Today we're cutting through all the heavy crypto jargon to unpack this massive battle for the future of digital money.
Absolutely.
But before we get into the existential threats and why Wall Street is so violently divided here, I do want to mention StockOracle. It's the AI-aided stock research platform we use for fundamentals, valuation estimates, moat analysis.
Bull and bear insights, comparisons, watch lists, portfolio research. Yeah, exactly. All that good stuff. There's a special 14-day trial link below in the description. Just a heads up, it is an affiliate link, so the channel may earn a commission at no extra cost to you.
And we always have to remind you, StockOracle is not financial advice. It's not a buy or sell recommendation or a trading signal service or, real-time market data.
Right. AI insights and valuation estimates can be incomplete or wrong, and the data may be delayed, so always verify important facts yourself.
For sure. So jumping into Circle, to understand why the market is pricing in so much panic, we have to look under the hood at how they actually make cash.
Right, their revenue engine, which actually reveals this massive hyper-concentrated vulnerability.
Yeah, let's look at the first quarter of 2026. The headline numbers look incredibly robust at first glance. They pulled in $694 million in total revenue for Q1.
Which is a massive achievement for a fintech company.
It is, but the vulnerability is in the composition of that revenue.
Yeah.
Out of that $694 million, a staggering $653 million came from just one single source.
Wait, that's like 94% of their entire revenue stream? Yep, 94%. And it all comes from reserve income from USDC collateral.
Okay, let's pause and just unpack how that mechanism actually works, because it's the foundation of everything else we're going to talk about today.
Right.
When you or, some massive institutional player wants to use a digital dollar, you hand Circle a real US dollar. They give you a USDC token in exchange.
Exactly.
But they don't just, lock your paper dollar in a dusty vault. They take it, they go out and buy a safe yield-bearing asset, usually short-term U.S. Treasury bills, and they just pocket the interest that those treasuries generate.
And the beauty of this model over the last couple of years is that interest rates have been sitting around 5%.
Right.
So when you are sitting on tens of billions of dollars in collateral and the government is paying you 5% just to hold it, you are effectively minting money without taking on massive credit risk.
But I see a massive structural flaw there.
Oh, absolutely.
What happens when the depositors start asking for their dollars back? Because between March 31st and July 30th of this year, the total supply of USDC contracted by $5.2 billion.
Yeah, bringing the total supply down to $71.8 billion.
Which is a 6.8% drop in just a 4-month window. It's like a bank where the depositors are slowly walking out the door, but the bank relies entirely on the interest from those specific deposits to survive.
That's a perfect analogy. The math on that is just brutal for Circle. If your only real source of revenue is the interest you earn on deposits, a shrinking deposit base means a shrinking top line.
Right. Every time $1 billion in USDC is redeemed, that's $1 billion less they can deploy into treasury bills.
Exactly.
But let me push back a bit. If 94% of their revenue is tied to this one mechanism, how much runway do they really have? Because even with a $71 billion supply, that is still an astronomical amount of capital-generating yield.
True.
So why is a 6.8% contraction triggering a 68% drop in the stock price? That seems like a total overreaction.
Well, it's because the market isn't just looking at the shrinking supply, right? It's looking at the yield itself. Circle has this extreme sensitivity to macroeconomic policy. They are entirely at the mercy of the Federal Reserve.
Oh, right, because of the rates.
Exactly. If the Fed cuts the target rate by a tiny 0.25%, just 25 basis points, Circle automatically loses roughly $179.5 million in annual gross reserve income.
Wait, really? Just off a 0.25%?
It vanishes overnight.
Wow.
And the directional winds are already shifting. We saw 3-month Treasury yields fall by 14 basis points just by the end of July. The market is pricing in future cuts, which means they are pricing in the evaporation of Circle's core profit engine.
Okay, so this brings up something that genuinely confuses me. If they have been operating in this high interest rate environment, pulling in $653 million a quarter just for holding assets. How are they still losing money?
That is the big question.
Because if you look at their trailing 12-month financials, their earnings per share is negative $2.91. If they can't turn a profit when the economic weather is, like, perfectly engineered for them, what happens when it actually rains?
That is the exact question keeping institutional investors awake at night. A lot of that negative margin comes from the massive overhead of building global compliance infrastructure and regulatory licensing.
Right.
And crucially, the payouts they have to make to their distribution partners to keep them using USDC. It leaves very little buffer if they get squeezed on three fronts at once: shrinking balances, falling yields, and rising demands from partners.
So a changing Fed rate is just bad weather. They can theoretically survive bad weather by cutting costs.
Yeah, theoretically.
But what they might not survive is the climate changing entirely. And that takes us to the massive coordinated external threat they are facing. Because if you want to understand Wall Street's panic, you have to look at the consortium of over 140 massive firms that just launched a direct attack on Circle.
We're talking about the launch of OpenUSD on June 30th. And it's vital to understand this isn't just another crypto startup in a garage.
No, this is the heavyweights.
Right. BlackRock, MasterCard, Coinbase.
Wait, if this consortium is launching a rival, I need to test a theory here. Circle has immense brand dominance, right?
Oh, for sure.
So why should they care if a new consortium launches a coin? Can't Circle just rely on their massive head start and outmarket them?
They can't, because OpenUSD isn't trying to beat Circle at marketing. They are fundamentally changing the economic rules of the game using what is called a pass-through model.
Okay, unpack that for me.
Let's use an analogy. Imagine Circle is a casino. They operate the tables, they hold the chips, and at the end of the night, the casino keeps all the winnings.
Makes sense. Great business.
OpenUSD is a new casino that opens up across the street, but their killer feature is that they take the bulk of the casino's winnings and pay it directly to the card dealers and the promoters who bring players in the door.
Oh, well, so the consortium is essentially giving away the reserve income, that exact yield that makes up 94% of Circle's revenue, and handing it to the distributors.
Exactly. They are turning the profit margin into an incentive mechanism. If you are a digital wallet provider, you distribute the coin, and you get a massive cut of the yield on the back end.
That forces Circle into an impossible corner.
Totally.
They either lose their market share because distributors jump ship to get paid, or they have to destroy their own margins to compete and start paying out their own reserve income.
It is a brilliant, aggressive move to commoditize the stablecoin layer. And this isn't just theory. Visa just officially launched a platform supporting OpenUSD on July 16th.
Visa. When the largest payment network in the world starts building rails for the competitor, that is terrifying.
Exactly.
And that perfectly explains the Wall Street fallout. I saw Morgan Stanley downgraded Circle to underweight and slashed their price target down to $38.
Yeah, Morgan Stanley cited this exact structural shift. They slashed their 2027 USDC supply forecast by a third and their 2028 forecast by an unbelievable 44%.
Because they believe the era of the stablecoin issuer hoarding the yield is dead.
Right. They are being attacked from the top down by the Federal Reserve and from the bottom up by 140 financial giants dismantling their distribution network.
So to summarize, the core product is shrinking, the company is unprofitable despite peak interest rates, and the biggest players in finance have teamed up to steal their customers.
It is a brutally difficult narrative to overcome.
And the stock chart reflects that brutality.
Yeah.
Like I mentioned, trading around $60.95. Plus, we have to talk about the insiders. Over a recent 90-day period, insiders dumped a net 2 million shares.
When you see executives offloading equity at that scale while the core business is under siege, the market takes that as a flashing red signal.
Right. But let me play devil's advocate for a second. Insider selling isn't always a death knell. Is Wall Street universally bearish here, or is there another side to this trade?
This is where it gets fascinating, because Wall Street is actually violently divided.
Really?
Yeah, the analyst dispersion is huge. Contrast Morgan Stanley's bleak $38 price target with Bernstein's target, which is sitting at $140.
Wait, $140. That implies a staggering 118% upside from where the stock is trading right now.
Yep.
How can two highly sophisticated Wall Street institutions look at the exact same balance sheet and arrive at valuations $100 apart?
Because they are completely disagreeing on what Circle actually is. Morgan Stanley is valuing Circle based on what it is today, a yield harvesting machine that's losing its engine. Bernstein is valuing them based on the infrastructure they are quietly building for tomorrow.
So you see a coiled spring for global B2B payments.
Exactly. And institutional contrarians are backing that up. Kathy Wood's ARK Invest recently bought Circle shares as part of a $43.5 million allocation.
You don't allocate over $40 million unless you believe the defense strategy is going to work. So what is the bull case? What is Circle actually building to defend themselves?
Well, they aren't sitting still. The cornerstone of their defense is regulatory legitimacy. They just secured a highly coveted limited-purpose trust charter from the New York Department of Financial Services.
I need you to break that down for me. Why does a specific state charter matter so much? It just sounds like a bureaucratic flex.
It's the difference between being viewed as a rogue crypto startup and a legally compliant institution-grade partner. Legacy banks are terrified of regulatory risk. By securing this notoriously strict charter, Circle effectively passed the hardest background check in finance.
Oh, so that charter is the key that unlocks the legacy banking vault.
You got it. And we are already seeing the results. They are building institutional rails right now with Standard Chartered, BNY, Nomura, and an IBM patent deal.
So the strategy is Circle realizes the pure reserve income model is dying, so they want to become the default digital rails for the legacy financial system.
Generating massive transaction fees instead of just harvesting interest, yes.
It sounds like Circle is building a state-of-the-art multi-billion-dollar highway system with these massive bank partnerships and New York charters. But right now, there are only a couple of cars driving on it.
That is the central tension of the stock.
Because look at their push into agentic payments. AI agents executing automated microtransactions. It sounds futuristic, but if you look at the actual traction, agentic payments are only doing about $41,900 a day in volume.
Yeah, which is basically a rounding error for a company this size. Infrastructure doesn't pay the bills until cars are actually driving on it.
So what will it actually take to get traffic onto that highway? What catalysts do we need to watch?
Well, you need to keep an eye on Circle's upcoming August 5th Q2 earnings call. The main question there is, will the USDC supply stabilize?
To prove OpenUSD isn't just going to drain them to zero.
Right. And the second major catalyst is in Congress. The Clarity Act is currently stalled. If that legislation passes, it provides a clear federal regulatory framework.
Oh, which would turn their New York regulatory wins into a massive advantage.
Exactly. They'd be one of the only companies legally ready to operate at a federal scale on day one.
Wow. Okay. So this isn't just about one stock. It's about the plumbing of the future digital economy.
Absolutely.
Before we wrap up, I just want to remind everyone about StockOracle. We mentioned the 14-day trial link in the description. Again, not financial advice, but a great tool for your own portfolio research.
For sure.
But I want to leave you with a final thought to ponder that builds on everything we've talked about today.
Let's hear it.
If stablecoins truly become the foundation of everyday global transactions, does the underlying issuer actually get to capture the wealth?
That's the real question.
Right. Or does the market eventually force digital money to become a low-margin public utility where nobody makes a massive profit?
It really makes you wonder if issuing digital money can ever be a high-margin business long-term.
It's a huge shift. Keep an eye on where the yield goes, and we will catch you next time on Market Pulse Daily.